Welcome to this explainer. Today, we're tackling line 1, ASC 305, cash and cash equivalents. We are going to completely demystify what is arguably the most scrutinized line on the entire balance sheet. We'll be breaking down the core definitions, looking at exactly what actually qualifies as cash, what absolutely doesn't, and why getting this wrong can cause a massive headache for literally everyone involved in a business. Okay, let's dive into this. It's kind of wild when you think about it. When you look at a balance sheet, cash seems incredibly simple, right? It's just the money in the bank. But in reality, it is highly regulated by some very strict accounting rules. Lenders, investors, and auditors, they all look at this line with a magnifying glass. And why? Because it represents the actual lifeblood of the company. It's not just about how much money exists, it's about exactly how that money is classified.
So here's our roadmap for building out this foundational framework today. We're going to cover the first balance sheet line, the 3 specific cash buckets, what is not cash, the incredibly high stakes of accurate reporting, and we'll wrap up with profit versus cash.
Section 1, the first balance sheet line and the 3 cash buckets. Let's lay the foundation.
Now, what's really interesting here is how strictly everything is categorized. Every single bank account and fund a company holds falls strictly into one of 3 distinct buckets, no gray area. Bucket number 1 is simply cash. This is your money with immediate, unrestricted access. Think physical currency and standard demand deposits. Bucket number 2 is cash equivalents. These are short-term investments that are so highly liquid they're practically the same thing as cash. Now, these first 2 buckets, they get combined onto one single line on the balance sheet, cash and cash equivalents. But then we have bucket number 3, restricted cash. This is cash the company cannot freely use. It's locked up by a contract, a law, or maybe a lender requirement. And notice the location, it is strictly separated.
Listen, you have to hear this loud and clear. Restricted cash must always be presented on a separate line. You never combine it with unrestricted cash. Why? Well, because combining them vastly overstates the company's available liquidity. Think about it. If you tell investors you have $10 million in cash, but $5 million of that is locked in an escrow account you can't even touch, you are not painting an accurate picture. Mixing these up is actually one of the absolute most common balance sheet classification errors out there.
All right. Section 2, what is not a cash equivalent? The trap.
Beware the trap, folks. In the finance world, there are plenty of financial instruments masquerading as cash equivalents. Okay, picture this scenario. You're managing the company's treasury. You bought a 6-month treasury bill exactly 4 months ago. Today, as you're preparing the balance sheet, it only has 2 months left until it matures. So under the standard 3-month rule, does this count as a cash equivalent? Take a second and really think about your answer.
So the crucial point is, the answer is no. No way. It completely fails the test. The 3-month rule for cash equivalents is based entirely on original maturity, measured strictly at the date of purchase. It doesn't matter at all that only 2 months remain today. Because it was a 6-month instrument the very day you bought it, it is classified as a short-term investment, period, not a cash equivalent. This golden rule catches professionals off guard all the time.
And honestly, that T-bill is just the tip of the iceberg. It is so easy to misclassify other instruments if you aren't paying attention. A 6-month CD fails. The original maturity exceeds 3 months. It belongs in short-term investments. A 5-year government bond fails. Obviously a long-term investment. What about shares in another company? Fails. Stock value fluctuates way too much, so those sit under equity investments. Trade receivables? Well, that's not a cash holding at all. It's just a promise to pay in the future, so it goes right into accounts receivable. Even derivative instruments like FX forwards or options, they fail because they are contracts about future cash, not a cash holding today. They belong in their own derivative category under ASC 815. You have got to be incredibly strict with these definitions.
Moving on to Section 3, why accurate cash reporting matters, the stakes.
Let's step back for a second. Why does this level of accounting pedantry actually matter? And this brilliantly illustrates the point. Getting this wrong has massive, real-world fallout for everyone connected to the business. Look at how one single classification error ripples outward. For management, if cash is overstated, they make terrible spending decisions, using money that's actually locked up. For lenders, if restricted and unrestricted cash are mixed, they are literally making loan decisions based on false liquidity data. For investors, hidden restrictions completely distort their view of the company's true financial runway. For auditors, finding unreconciled balances, misclassified instruments, and missing restricted cash disclosures are among the most frequent audit findings. And finally, for the finance team itself, getting this wrong leads to compounding prep errors and missed foreign exchange remeasurements, period after period. Accurate reporting is the only way to tell the actual truth about a company's real liquidity.
Finally, Section 4, Profit versus Cash.
This brings us to a fundamental truth of business operations. It's the ultimate line that separates companies that survive from those that fail. Profit and cash are not the same thing. A company can show an incredibly healthy profit on their income statement, purely on paper, and still completely collapse if it runs out of cash. Profit is an accounting concept, right? It includes non-cash items like depreciation and accruals. But cash is the real, hard money the company can actually spend today to keep the lights on. That is exactly why the cash flow statement exists right alongside the income statement. You absolutely need to understand both, but at the end of the day, cash is what dictates your survival.
So getting that 3-bucket classification right, cash, cash equivalents, and restricted cash is the absolute bedrock of your balance sheet. It determines where balances appear, how they flow through the cash flow statement, and what you disclose to the world. So as you evaluate any balance moving forward, the ultimate summarizing thought you should always leave yourself with is this: can the company freely use this money right now? Keep that question echoing in your head as you process everything we've covered in this explainer.